So, welcome to the Psychology of Investing seminar. I have Mark Peterson from BlackRock with us today, and he's the director in the Advisor Insights team focused on investment strategies and education. He's a 25-year industry veteran with extensive expertise and experience educating financial professionals and investors on markets and investment topics. And his responsibilities include relating BlackRock's investment strategies and investment views to financial professionals and clients. And he's the author of the popular Student of the Market monthly publication that's distributed widely to financial professionals across the country. So again, we've got a seasoned veteran right here, and he actually created this presentation. And anyway, we've been through lots of market cycles. I mean, we're all adults, and we've been around for quite some time. And we've been through strong bull markets. We've been through bear markets. But when we go through these periods of bull markets, we tend to forget how we reacted and our emotional response in the bear markets. We had 2022 was a reminder that both stocks and bonds can be down at the same time, although that doesn't happen very often. But how we approach these markets and react to these turbulent times will have a dramatic effect on our portfolios and therefore our standard of living. So the way that we approach these markets has, quite frankly, a greater impact on the wealth in your portfolios than rates of return. Because what we found is that they don't time the market well. They pull money out too late, they get back in too late, and they miss out opportunities. And so anyway, I'm going to kind of turn it over to you, Mark, right here, and kind of talk about the psychology of investing. And hopefully this will kind of give you some perspective that when we go through these volatile times and the markets are down, maybe this will influence the approach that you take when we go through these periods. So Mark, I'm going to hand it over to you.
Thanks, Jim. Absolutely. One of our favorite topics here, psychology of investing, which is really understanding some of the pitfalls that we all fall into as humans when we think about money, when we think about investing. This is something that's really been studied here the last probably 20, 30 years, both academically and industry-wide. So we're going to take some of those lessons that we've learned, as Jim mentioned, really trying to make all of our emotional behavior better when it comes to our investment thinking, our investment planning. It's amazing. Even some of the best investors we work with fall into these pitfalls. So don't feel bad. I think we're all subject to them. When you think about what's important with an investment plan, I think we always think about the middle, right? Think about what you own. What does the portfolio look like? But really, when we talk about it at BlackRock, it all starts with the foundation, which is the bottom, what we call investor behavior. So just your ability to keep your emotions in check, keep them on the sidelines. That's what makes good investor behavior. Basically not derailing your investment plan at the worst point in time. And again, it might seem obvious, and I don't think we spend enough of time as an industry talking about it, but good investor behavior adds to performance, adds to your outcome over time. And I think Warren Buffett said it the best when it comes to this investor behavior and what makes a successful investor. He just said, we don't have to be smarter than the rest. We just have to be more disciplined than the rest. This is what we'll touch on the rest of the way is let's build up that discipline muscle. That's what makes a great investor, is just having that good discipline going forward. So what we'll do the rest of the way, we'll talk about three pieces here. We'll talk about envy and loss, number 1 and 2 there. This is probably the emotions where we see most of the mistakes. And then number 3, just building in some of that discipline more directly. So let's talk about envy and regret. We'll talk a lot about envy and regret. We should only regret bad outcomes, but oftentimes we regret what could have been, right? We think about all the decisions we make and think about how many times you say, well, the outcome wasn't bad, but it would have been better, even better, if we did things a little bit differently. That's envy and regret. And it can be really powerful emotion, can be really detrimental to your future decision-making as well, if you're really riddled by that envy and regret. There's a great study, the first slide here, that does a great job highlighting this envy and regret. And it has everything to do with the Olympics. And it looks at the fact that, and this is a study they do every time the Olympics rolls around, doesn't matter the year, the country, where the athlete's from, it always turns out the same. And they look at the happiness of the medal winners on the podium. First off, it's crazy that somebody actually studies that, but it's a great behavioral study thinking about that envy and regret. And of course, the gold medal winner's the happiest. We throw them off the slide. It's not that interesting. But think about the perspective of that bronze medal winner for a moment. They're just happy to be on the podium, right? They're just happy to be there because they know they were just as close to not medaling at all. And I'm not sure what you get for fourth place in the Olympics, but I know it's not a medal or being up on the podium or getting your country's flag raised in your honor. So an enormous drop between third and fourth place in the Olympics. And you see that in the happiness of the bronze medal winner. They're just happy to be there. And contrast that with the silver medalist for a moment. Silver medalist, they're thinking about what they could have done differently to make up those fraction of inches, fraction of seconds. That's the difference between gold and silver in the Olympics. And that is what the silver medalist is dominated with and their feelings and their thinking on the podium. So that really can impact their overall experience. And think about that from an investing standpoint. This slide is one of our favorites. We might have shown it to you in the past, but it really does highlight this emotional challenge that the diversified portfolio creates. We often say that the diversified portfolio doesn't always feel good because it's ripe with this regret and envy at various points of the cycle. You can see some of these periods. Look at 2008 there. And this diversified portfolio is roughly 60% stocks, 40% bonds. It's going to have different allocations and different weightings, but you can get a flavor for you still lost 26% in the diversified portfolio in 2008. That never feels good to lose your quarter assets in a calendar year. But then look at the period on the other side. Look at that 2009 to 2019 period. The diversified portfolio trailed in a huge way, 219% to over 350% for stocks. This is what we mean by the emotional challenge of that diversified portfolio, because you lose money still in a tough market like we saw last year, and you don't make as much money in years like this year when the stock market is very concentrated and you're seeing the best returns in the largest stocks. Your portfolio is just not going to make as much, and that can be unsatisfying as well. And you just rinse and repeat that over various cycles. You can see at the very bottom here, if we add up this 20-plus year stretch, the diversified portfolio actually ends up ahead. Look at the returns in the gray, right? The diversified portfolio over this 20-plus year stretch actually beat the U.S. stock market, and obviously did so with a heck of a lot less risk because it was diversified. But this is what I think a lot of folks miss with that diversified portfolio, is that it might not feel good along the way, but we can get to what we call at BlackRock winning more by losing less. Winning more by losing less, where you don't need all the upside of what the bull market brings, right? Just get a chunk of it. You don't need all of that 350%. Just get a chunk of it. And equally as important, if not more, is limiting losses in those tough markets, right? Instead of being down 37% in 2008, let's be down 26, which still doesn't feel good, but that still helps us from an overall loss mitigation standpoint. So for us, again, winning more by losing less. Just get a chunk of that upside, minimize that downside. You can see that it's really all about that regret and envy emotion. Here's that loss story that we touched on earlier, except we added withdrawals. This is just the math on the pure loss side. So here's that minus 50. Now all of a sudden you got to be up 100% to get back to break even. You can see the 11% on the bottom of the slide. But look what happens the further you get to the right side. The deeper the loss gets, the more likely your portfolio gets impaired. Look at that. Look at the minus 50 up 100, right? Just where we started here. One step to the right, that just an additional 10% for loss from minus 50 to minus 60. Now all of a sudden you've got to be up 150% to get back to break even. This is why limiting losses is so critical. This is why you don't want to get caught up in that envy and regret emotion. Too much of that can lead you to too much risk, too much downside in your portfolio. So let's switch gears, go to the other end of the spectrum here. Just the loss emotion. This is probably one of the most studied emotions in the psychology of investing world, is the fact that the loss emotion can make you do all kinds of irrational things. And one of the things they found for most investors is that losses feel twice as bad as gains feel good. So just think about that emotionally. Losses feel twice as bad as gains feel good, is what they found for a lot of folks out there. And I think we can all probably relate to that at different points in our investing career. But it does create some pretty powerful negative outcomes. And when you get this loss emotion revved up, it wants you to do something. So if you just look at the next slide, it's another study that's been done that has nothing to do with markets and economies again, more sports, but this time soccer or football, they call it in Europe. And you can see that the penalty kick. So I'm not sure if everybody's familiar with the penalty kick, but it's often used to decide a tie match. So it's just the goalie against a kicker one-on-one. They'll use it to decide the World Cup, the World Championship. And there's tremendous pressure on the goalie in the situation because those professional soccer players can kick the ball past the goalie before he can even move or react. So they've done studies that says, hey, the goalie should sit right in the middle. He should do nothing and wait for an improperly struck ball because he'll never stop a well-struck ball. It'll be past him before he can react. But what the studies show, sit right in the middle, wait. But what actually happens, and you can see in the box there, 94% of the time, the goalie is going to jump left or right in anticipating where the ball is going before it's actually kicked because they can't help themselves. They're overwhelmed by what's known as the tendency towards action that we have as humans. Whenever that loss emotion, whenever anything's broken, we naturally want to do something to try to fix it. So it's a very natural thing, especially in a pressurized situation. Think about it. If the car breaks down, you have to take it into the shop to fix it. It's not going to fix itself. So in a lot of ways in our lives, this loss and action bias, tendency towards action, is a good thing, but not always in everything in our life is the best thing. And you'll see it. They actually say the best place for the kicker to kick the ball is kick right at the soccer player's or the goalie's head, right where his head starts, because it's never going to be there. And it's like clockwork when you watch these penalty kicks. The goalie just can't help themselves. They don't want to look like they sat there, did nothing, choked, let their teammates and country down. So they're overwhelmed by this action bias. Just understand that's natural for all of us as humans. And of course, this relates to investing in such a big way. Think about how many times where we get that loss emotion revved up, the tendency towards action kicks in, we want to do something with our portfolio. That's such a natural reaction. This is a chart that I think every firm in the financial industry has to have. And it just shows what happens if you miss the best days in stock market history. If you just stayed invested the last 20 years, 100,000 grows to almost 650,000, which is pretty crazy if you think about it, considering we've had some pretty big economic and bear markets in there. But look what happens if you just miss the best 5, 10, 15, 25 days in stock market history. Granted, you'd have to be pretty unlucky to miss all 25, but missing the best 5 is not that hard, because what happens is these best and worst days in stock market history tend to be right on top of each other. So those worst days, when that loss emotion gets revved up the most, you're going to have some of those best days on the other side. So what happens is the loss emotion gets revved up. Investors want to do something with their portfolio, not experience those losses because they feel twice as bad as gains feel good. So it's a natural thing to give into that temptation to move your portfolio to the sideline, sell some stocks. It's amazing. Again, even some of the best investors we work with, this is probably one of the biggest mistakes, where they try to time the market versus time in the market, which of course is that old market adage. But it's amazing how often it happens. But understand where it comes from. It's from that loss emotion getting revved up. Then that tendency towards action kicks in. You want to do something. You don't want to just sit there and take your lumps. But as we know, because those best and worst days sit right on top of each other, don't give into that temptation. Let time in the market work in your favor. That's what's worked over time. And just an example of this, Jim, if you remember back in 2020, in March of 2020, we had 3 of the worst trading days in stock market history. We actually don't have a slide on it, but you have 3 of the worst days in stock market history back in March of 2020, right when the pandemic and really struggling with how we were going to shut down the economy and what we were going to do. 3 of the worst days in stock market history. We actually had number 2 and 3 only behind October of 1987. But we also had in March and April 5 of the best days in stock market history on the backside of that. So think about that. If you were overwhelmed by that loss emotion, wanted to do something with your portfolio back when COVID was taking hold, you probably missed 5 of those best days in market history on the other side. That can have an enormous impact on your return going forward. So, and I think another quote from Warren is always, and you've probably heard different variations of this, is try to be fearful when others are greedy and greedy when others are fearful. It's just such a great way to think about investing and the right way to keep your investment mentality, right? Almost be a little bit contrary to the way the market and the way most investors are thinking. But the last section is trying to build in some of that discipline that we touched on in the beginning, just some best ideas from teams across the country. I think first off on the first slide, again, we don't talk about this enough. Lean on Jim and his resources. He can be that emotional check and balance for you. It's amazing how often I think this gets passed over by the industry is we can be that emotional check and balance. We can be that source of education, which only helps build up that discipline muscle over time. Let Jim do that for you. Don't underestimate that. It's performance and outcome at the end of the day. And one of the best things we've seen from teams across the country, I'm sure you're doing this to some degree already, and you can think about having a bear market plan and talk about what are you going to do every time the market's down 20, 30, 40%. And talk about it every time you talk with Jim. What are we going to do if the market's down 30, 40%? Don't just wait to get there at what can feel like that emotional roller coaster. Talk about it at each step of the roller coaster. And especially for those folks that tend to be really emotional during that loss period, be very deliberate. Even when the market's doing great like it is this year, hey, what are we going to do if the market's down 30, 40%? Maybe we're going to, right, increase our contributions, add a little bit more to the models, right? Take advantage of prices being down. I know I certainly do that with my 401k and some of my 529 college accounts last year, right? I'll dial up that contribution when prices are struggling like they did last year. Or maybe you take advantage and take some tax losses. I know that was a big thing last year as well. Reposition the portfolio a little bit, take some losses, make the accountant happier, reduce the tax bill. Or maybe it's even selling, right, some bonds and buying more stocks at cheaper prices. All those are good bear market plans. But what we heard from investors across the country, if you talk about it consistently, you're much more likely to execute when you actually get into the heat of the battle. Think about how hard it would have been to rebalance your portfolio like our models did back in March of 2020 at the end of March, right? Because there was so much fear, so much uncertainty with the pandemic. Stocks were down over 30%. If you rebalance back, it was a winner trade. That's often very difficult to execute just because you're not prepared to deal with that loss emotion, that fear, uncertainty that's at that bottom of the cycle, that bottom of that roller coaster. So we've just heard this consistently from teams that employ this, from investors that employ this with their advisor. Again, you're probably doing this to some degree, but if you're worried about the emotions, hey, what are we going to do if the market's down 30, 40% next month, next quarter, next year? Let's have that plan in place because that'll lead to better execution when you're in the heat of the moment.
I think I was an example that just happened in the last couple of months, Mark, was we had the debt ceiling. So what did the media say? That, the world's, we're going to default and then pull your money. I mean, I fielded a number of calls from clients saying, I'm really nervous about the debt ceiling and just everything crashing. And, basically I said, listen, we've seen this movie before. Stay fully invested. We're going to get through this, and so. Yeah. I mean, I don't want to toot my own horn, but this is some of the emotional stuff that I help my clients do is like, we're going to be all faced with these situations. It will never stop. The question is, how do you deal with it? So anyway, this little chart right here with the, the best and the worst, this stuff happens all the time. Yeah. So anyway, I mean, that's
a great example in the debt ceiling. I think it really flows into the next slide where we talk about one of the other big challenges that I hear from, and this is probably bigger than at any point in my 30-year career, is some of those news sources that we so often rely on, they're so much more polarized today than in the past. It's amazing investors, whether it's a debt ceiling or inflation or whatever it might be, maybe the election next year, right, will kick up all kinds of difficult news stories. Understand that these news sources are an enemy to our investor discipline, and especially forecasts about the economy or the market. They always tend to show up on some of these financial TV channels, and I'm certainly guilty of watching these things all day. But understand that they can be an enemy to your investor discipline. And one of the realities with forecasts is it's really difficult in the short term to get forecasts right. Jim and certainly us at BlackRock, we have a pretty good idea where stocks and bond returns, where we're heading in the next 5 or 10 years, right? We won't get it exactly right, but we'll get it within a range, a pretty tight range. But it doesn't mean we can make predictions over the next 3, 6, 12 months, even in the short term. So we never want to take make enormous movements with portfolios based on those short-term predictions. Understand that. This is actually a study that we did looking at how often Wall Street experts get the direction of interest rates right from one year to the next. Not even the amount that they go up or down, just whether they go up or down in general. So you got a 50-50 chance of getting it right. Interest rates never stay the same. You can see the coin gets it right half the time. Wall Street experts a little bit less than that at 47%. And one of my favorite philosophers, Yogi Berra, on the bottom there, famously said, it's tough to make predictions, especially about the future. But just understand some of these sources of news, some of these stories that you hear, like the debt ceiling or the election, they're short-term in nature, and they really don't change the longer-term path. Don't let them derail your investor discipline. It's, again, amazing how often this happens today versus when I started in the industry 30 years ago. And I think that does it for us. The next slide just ties it all together for us and really starts out where we began, good investor behavior is critical to investment success. It's that foundation of good in any good investment plan. Don't underestimate that. Don't let that erode your investment success. And it's all because of some of those emotions that are natural to us. We talked about envy and regret, right? Remember that silver medalist story, right? We all have that silver medalist feeling from time to time, especially with that diversified portfolio. But remember that winning more by losing less, right? That diversified portfolio won't always feel good along the way, but understand we're trying to get to that winning more by losing less story that takes advantage of that math and limits losses. And then on the other side, that loss emotion, the fact that losses feel twice as bad as gains feel good. Understand that if that loss emotion gets revved up, that tendency towards action might kick in, and you might have that temptation to try to time the market. Remember those best and worst days sit right on top of each other. They live in that same neighborhood. So don't give in to that temptation. The worst thing you could do, as we saw to your outcome, is miss some of those best days on the other side. And then finally, right, lean on Jim and team. Let them be that emotional check and balance. Don't underestimate that. Have a bear market plan, especially if you get really emotional. Try to tune out some of the news and other things that we see on a daily basis. Don't let any forecast get in the way, right? We know where stocks and bonds are headed. We won't get it right exactly over the next 3 or 6 or 12 months, but generally longer term, stick with that plan. That's the best way to achieve better financial outcomes. Keep your emotions on the sidelines. All those things help you build up some of the discipline. And really the last slide, so a good slide to end on here. I think we can all appreciate this over the last couple of years. With the friends, the family, the loved ones, that's where your emotions belong. They don't belong in your investment planning. So I'll stop there, Jim. See if there's any questions, thoughts, or comments. But again, for us, just, always an important story. But I think everything we've been through the last couple of years, just super important with what we've lived with here.
Yeah, I don't see any questions in the chat or the Q&A. Just want to remind people to download the handouts. The presentations were in there. So you can look at that at your leisure after the presentation. A lot of the concepts that Mark was talking about have to do with both the accumulation and the distribution phase, especially in the accumulation phase. When we transition to the distribution phase and retirement, that's when the rules change a bit. So many of you that are on this call are already clients of mine where we've done extensive retirement income planning, where we try to raise that income floor and try to do different strategies to minimize risk and be able to navigate these different market cycles. So that's really ultimately where we can kind of help, is to kind of tie these things together. You need to have the right approach, but you also need to implement a right strategy that makes sense for you guys. So I also want to thank Mark Peterson for joining us today, giving a great presentation. Mark, thank you so much. You did a great job. I actually learned a lot from watching your presentation as well. And so for all you out there, I hope this was helpful, and we look forward to seeing you in our next quarterly market update. So take care now.
Thanks, everybody. Thanks, Jim.